So in this video, we're going to talk about cash versus accrual that's specific to revenue. And what we need to understand is that revenue is the income statement side and accounts receivable is going to be the balance sheet side of the equation. Now, the main difference between the cash and accrual basis for revenue is that revenue is recognized under the cash basis when the cash is actually received, meaning when the customer pays it to the company, they receive the cash, that's when they would recognize the revenue under the cash basis. Now, under the accrual basis, we would recognize revenue when it's earned. Now, there's a whole laundry list of items or requirements that must be met for revenue to be recognized under US GAAP, specifically ASC 606. We're not going to get into that, but the important thing to know is that revenue isn't recognized only when the cash is received, right? It's when it's earned. So that's the fundamental difference between revenue when it comes to cash versus accrual. Since we're using the balance sheet approach here, we need to think about what is the corresponding balance sheet account for revenue? Well, it's going to be accounts receivable. So let's take a quick look at the journal entry so that we understand the relationship between revenue and accounts receivable. So when we record a credit sale, the journal entry would be a debit to accounts receivable for $5 and then a credit to revenue for $5. And then when we collect the cash from our customer, well, we would debit cash and then remove the receivable from the balance sheet via a credit. So now that we've briefly talked about the journal entries associated with recording a credit sale and ultimately collecting the cash, since we're using the balance sheet approach for the cash to accrual, we need to now understand what increases accounts receivable and what decreases accounts receivable. So accounts receivable is going to be increased when the company records sales on credit. And when it comes to credit, that means the company's extending credit to that customer and allowing them to pay at a future date, right? So we would issue an invoice. Credit does not mean the use of credit card. Credit cards, for all intensive purposes, really just represent cash because then the liability is shifted to the credit card company, right? So when we think about credit, think about issuing an invoice and then the customer paying us back in the future. So what decreases accounts receivable? Well, accounts receivable is decreased when the company ultimately collects cash from the customer. And going back to the cash basis, this is when we would recognize revenue on the cash basis. So now you can understand why there's a timing difference between revenue recognized on an accrual basis and revenue recognized under a cash basis, right? And it all relates to credit sales because we give our customers, say, 30 or 45 days to pay, right? So that timing difference, that represents the difference between cash and accrual when it comes to revenue. All right. So we've talked a lot about the journal entries, the balance sheet approach. Now let's go ahead and put it in action for an example cash to accrual question you're likely to see either on your college exam or on the CPA exam. So this question says that Shoes Mountain had the following financial information during year one. And it says, how much revenue would Shoes record on an accrual basis? Now let's look at what they give us. They give us cash collections during the year and it says that's $250, right? So that's cash that the company's actually receiving from customers. And then they had a beginning accounts receivable balance of $100 and an ending accounts receivable balance of $350. So the balance sheet approach, the roll forward for accounts receivable, it's going to be the same all the time. So I've set it up here, and as you can see, the first item is going to be a beginning accounts receivable balance, right? And then we'll think about, okay, what increases the account balance? Well, that's going to be revenue from credit sales. Now that's the plug here, right? That's what we don't know. That's what we need to solve for. And then what decreases accounts receivable? Well, that's going to be cash collections from customers, and that's $250, right? The question gives us that, and you'll see it's in red, right? Because that's decreasing accounts receivable. And then in this case, right, they give us the ending accounts receivable balance, and that's $350, so that's plugged in there. So now all we need to do is figure out the plug here, which is revenue from credit sales, and that would be the amount of revenue we should recognize on an accrual basis. Well, it's just going to be $500 here, right? That's the only number that causes this roll forward to balance. So think about it. If we had beginning accounts receivable of $100, we add in $500, that takes us to $600, and then we collected $250, so that decreases the accounts receivable balance back down to $350, and that's our ending balance. So we know that the balance sheet roll forward works, and now we're comfortable that revenue recognized under an accrual basis is $500, while on a cash basis, revenue would be $250, right? So that's the fundamental difference here. And then on our balance sheet, we would still have that $350 that hopefully we'll collect next year. So let's flip it around and say they want to go from accrual to cash. What would the question look like there? So basically the same thing, right? Shoes Mountain had the following financial information during year one. And then the question would say something like, how much cash revenue did Shoes collect during year one? So this is the beautiful thing about the balance sheet approach. As you can see, the accounts receivable roll forward, it's exactly the same, right? There's no switching up all these different formulas. It's the same setup. And all we need to do here is solve for cash collections. But again, we take the information from the question, put it in the roll forward. So at beginning accounts receivable, it's still $100. The question gave us that. And then revenue from credit sales, that was $600. And then cash collections from customers, that is our plug. And then our ending accounts receivable balance is $350. So the way to do this here is, okay, we add beginning accounts receivable and revenue from credit sales, right? Because the credit sales increased. That's a total of $700. And then to get down to $350, well, obviously we collected $350 of cash from customers. So that is a quick overview on how we can use the balance sheet approach for cash to accrual and accrual to cash when it comes to revenue and accounts receivable. No matter what variable they give you, as long as you can remember how to set up the accounts receivable roll forward, you'll be able to solve for whatever the question is asking you for.